Recording in progress.
Welcome, everyone, to tonight's Sunday macro wrap-up for Sunday, January 11th. New all-time highs in the S&P 500, as well as we have a pretty interesting week coming up with CPI on Tuesday. We have a lot of pretty good things to cover here on tonight's Sunday macro wrap-up. My name is Johnny. Welcome to the channel here. For those who are new to the channel or the Sunday macro wrap-up, the way that these work is that they are an hour long. The first 30 minutes is streamed online on our socials, and then the last 30 minutes of the hour is actually offline for our Macro Optics members. And that's where we will be getting into some of the Q&A as well as some actual ideas based off of what we're about to cover here in the first half. So with that structure in place, you know, for the people who are joining in our socials, make sure you share all that good stuff. And we can go ahead and get right into it here. Oh, and by the way, if you want more information, you can go to our website, macro-optics.com. You can take a look at some of the membership options there. And then, yeah, you can read more there. So let's go ahead and get into it here. With CPI coming up, it's pretty interesting because you have a little bit of a pivot point with this current trend that we're seeing in the macro environment, where it looks like we're getting a little bit of a reflation or even a resurgence in growth. And it's been pretty optimistic so far with the way that the market's been reacting. I mean, obviously with new all-time highs, a lot of people a couple of weeks ago, or even into the quote unquote Santa rally back in December, there was a lot of bearishness going on. And, you know, we were, you know, sharing with the group as well as on our socials, you know, hey, you know, the model is still suggesting that there's no loss in trend for the S&P 500. And so it probably wouldn't be a good thing to short it here. And then, you know, now we get new all-time highs, right? So, hold on a second, let me clear the drawings. So yeah, last week we had a pretty eventful week, and we had a little bit of a confirming evidence of this type of almost like dumbbell type of economy, where you have certain parts of the economy that continue to do very well, and other parts of the economy that are struggling and actually in contraction. And so we'll get into some of that macro data here, as well as taking a look at some of the other things that are developing. So taking a look at some of the macro data last week, we received some manufacturing PMIs, some of the ones that were pretty important, like the manufacturing one, which is interesting because a lot of these leading indicators like manufacturing, logistics, all are in contraction right now. But contrast to that, we're actually seeing some good news in things like the services PMI, which reached the highest since 2024. And so we're in a period right now where services and kind of like the consumption economy continues to do well. And then the manufacturing sector and the goods sector is in recession, essentially. And that's not too much of a surprise because the tariffs are really affecting the goods side of the economy in the United States. And since the United States economy is more of a service-based economy, in aggregate, the tariffs aren't as detrimental compared to the good side of the economy. And because of this, Services make up over 70% of all of the growth in the United States. Because the services sector is actually accelerating right now, it's creating this. It's essentially carrying the weight of most of the economy. And so, what's interesting is that you have inflation continuing to come down while growth is going up. That's more of a soft landing uh, type of Goldilocks environment, which is really what we've been experiencing over the past few weeks with things like materials. If we go to the charts here, the sector leaders right now in the S&P 500 is materials, and this has really been the big mover this year, along with financials, and then also two with industrials. So those three are what are called cyclical sectors, meaning they do well in certain environments and they don't do well in other type of major macro environments. You also have things like growth, which are things like tech, consumer discretionary, as well as communications, and then you also have defensive stocks or defensive sectors, which are things like healthcare, utilities, as well as consumer staples. And so we're seeing more of like the cyclicals do better than both growth as well as defensive. And what's interesting is that when taking a look at the trends of all the Mag 7, really the ones that are continuing to do really well are Google as well as Amazon. The others are pretty much lagging behind. So, things like Tesla, Apple, Broadcom, Nvidia, Microsoft, all of those are pretty much lagging behind. And so you're seeing a interesting capital rotation from these large mega caps, which were really the front runners over the past 3 years. And we're seeing a cycle into small caps, cyclicals, financials as well, things like that. And so we're definitely seeing a large capital shift right now. And so the question is, okay, how long is this going to last? Is this like the precursor to a more risk off environment? Like, what does this really say? And so this is all leading up to this next CPI report on Tuesday, because that's going to be the big tell if we're going to continue in this type of Goldilocks phase, right? Which is the confirmation of disinflation with accelerating growth, or are we going to get an unexpected kick up in the CPI print where it's higher than expected, and we head more into I guess like a stagflationary light type of environment. Now we're getting a little bit of mixed signals right now. The big one is with the large acceleration in the US dollar over the past week. I mean, look at this thing. It went from bearish trend into a single week and went to neutral trend in our model. And so this is a very unusual like V reversal in the US dollar. And so my team and I think that this is just a bounce and that'll continue to the downside. But it is pretty interesting seeing that there. But yeah, I mean, looking at our trading range model, it bounced right up to the top end of the trading range. So wouldn't be surprised if we get a little bit of a down move back in the dollar. But it's a trend that we really need to look at to see if it continues higher from here, even if it does have a little bit of a correction. And so, yeah, all eyes on the dollar this week, all eyes on CPI. Those are the main things that we are going to be looking at. But in terms of like risk in the environments or risk in the market environment, when looking at things like the volatility index, volatility remains optimistically low and in bearish trend, which is good for the underlying assets. And then also, too, when taking a look at credit spreads, let me see if I can find it here. So in taking a look at credit spreads, you can see that it remains in bearish trend and near cycle lows, which is very bullish for the markets. So it would be different if we were heading into more of a stagflationary environment where things are concerning. If we were starting to see credit spreads widen from here, like if credit spreads were in a bullish trend, if we saw the VIX near 20 or higher, I'd be telling you guys a totally different story right now. But because of these things, um, I think that there isn't really a huge need to get incredibly bearish right now. Now that doesn't mean in the very short term we could have any type of, it doesn't mean that in the short term we couldn't have a correction, right? I mean, the S&P 500 is at new all-time highs when taking a look at the SPY. Seeing where it closed on Friday, taking a look at the trading ranges right now, it closed right at the top end of the trading range around 695. And so when something closes near the top end of the trading range, it doesn't matter if it's in something that's super bullish or, if anything is at the top end of the trading range, you want to be, selling some of it. Or, I mean, if it's something that's in bearish trend, then you want to be going short, as long as it's on lower volume. And so what's interesting is that volume actually kicked up here on the weekend, and that's actually, again, it's a bullish signal when you see accelerating volume, accelerating prices. And so again, um, it just goes back to us saying there's not really a huge signal telling us to get bearish right now. In fact, it's the opposite, right? This is basically a soft landing signal from the markets. But taking a look at the calendar for this week here, going to our website, we have a market dashboard where you can take a look at other different things as well. But taking a look at the calendar for this week, CPI comes out on Tuesday, and then you also have producer prices and retail sales on Wednesday. And then on Thursday, we get the Philadelphia Fed index. So really nothing crazy except for Tuesday CPI. And then I think we're starting to get the next round of Q4 earnings, starting with banks this week. So we have that to look forward to over the next several weeks as well as we go into earnings season. But if we start to see that CPI continues to decelerate, this would confirm the Goldilocks situation that we're viewing right now and that we're expecting. And so we would get yields dropping to the low end of their trading ranges, signaling a green light to short bonds, and go back into things like Qs, tech, and also maybe even cryptocurrencies as well. Our model has been flip-flopping a little bit on Bitcoin. It did go bullish for about a day last week, and I actually made a video about it. But it went back to neutral. But I mean, it's looking like it's going to form. I mean, the chart looks good, right? Even if you're someone who's just a technical analyst, you would look at this chart and be like, yeah, I mean, this thing is forming a base here to go higher. And so, yeah, that's really what our team is thinking, is that we're going to continue to get a deceleration in the inflation CPI print. But if it does come out to be hot or, more than expected, then we could see yields continue higher, the dollar continue higher, and then a lot of things that are negatively correlated to the US dollar could have a potential correction there. So, again, really key pivot point here with CPI on Tuesday, and those are the bull and bear case there. And so, yeah, the contrarian position that we're really trying to look for here is being long some tech, because I think that everyone is crowding in to small caps, as well as, some of these other things that have been going up that we just mentioned, like financials, materials. And we think that people are getting underweight things like Qs and tech. So that could be an opportunity there. We were also talking about uranium miners in our community, as well as some particular cryptocurrencies. And then, yeah, depending on what happens on Tuesday with inflation, we want to keep an eye on the target rate probabilities for the March Fed meeting. At the timing of this video, there's a 68% chance, 68.9% chance that they're actually going to remain paused even through March, and then a 30% chance of a 25 basis point cut. If we take a look at the SOFR watch, we can see that right now it's pricing in the first 25 basis point cut in June of this year, on June 17th, and then just one more in September. And then really that's it for another year and a half, right? So this goes all the way out to December of 2027. And it's saying that the Fed is going to continue cutting until it reaches between 3.0 to 3.25% on their Fed funds rate, and then they're going to essentially just continue to pause from there. And hopefully, I mean that gives the Fed essentially 2 years to see, or really just 1 year to see if inflation comes back down to 2%. So we're getting down to the wire. It's really been what, since 2022. It's now been nearly 4 years since the Fed's been saying we have to wait until our 2% target for inflation, although it's never really came. Maybe this is the year that it happens, right? And the soft landing can be declared. Um, but yeah, lots of noise in last week's data, but really the entire signal was that the services number is carrying the market. Yeah, some notable things. The Challenger jobs report, job cuts fell to the lowest in 17 months, but the year in and of itself was higher than all the previous years since COVID, right? So that last year was the highest year cumulative in layoffs that since the pandemic. So that's definitely a trend to look out for. The jobs numbers came in pretty much as expected. Um, Employment rate remains relatively low, and it did go down for the month of December. And so it's going to be pretty interesting seeing the Fed shift from the labor market fears to now refocusing on what inflation is going to do. But yeah, I know that with last month's CPI, there was a lot of people talking about how if you just look at, since the government was closed, we had a lot of data that was missing from October and November for that November CPI print. And so we'll see if any of those numbers start to populate here and we can get a more accurate reading. And so this is really where a lot of uncertainty is happening with this inflation report that's supposed to come out on Tuesday. And so for me personally, I don't really like to gamble into these types of large events where the entire market is looking at it. What I'll do is I'll take some profits on things, and then after the event is over, then I can just reposition myself. You can always bet. You can always buy back in. You have to remember that. What's interesting is that when looking at the Cleveland Fed inflation nowcast, you can see that they have inflation continuing to decelerate, with the January number, which gets reported in the second week of February, is going to be 2.2%, almost 2.25%, which would be the lowest number since inflation resurged in 2022. So yeah, they were very wrong before though. So it just goes to show how there's a lot of volatility right now in terms of data. So yeah, the government shutdown over the past couple months is throwing a wrench into things. But when looking at the Atlanta Fed's GDP nowcast, we can see the impact of just how much that services report had on the overall growth outlook. Because once that services number came out, despite the manufacturing being low, despite the jobs numbers being what they were, this went from a 3.0% estimate to over five. Let me see what it was, 5.4, which is a pretty or 5.1 rather. So that's a pretty large acceleration in the GDP estimate for Q4 of 2025. And so yeah, it really seems like growth is reaccelerating here. But when taking a look at something like the yield curve, this is our yield curve phase signal indicator within TradingView. And what's interesting is that right now we're in this bull steepening phase, but the context in which the yield curve is steepening is what's called a twist, right? So a twist happens when you have two of the yields going in opposite directions. So right now we have the 2-year yield going down, at a faster rate or a larger magnitude than the 10-year is going up. And that's very unusual. That's a very rare thing that happens, and it's called a twist. And so, in taking a look at our yield curve phase signal bull steepening twist, now this isn't perfect, but this is generally what is being signaled, right? So, in the macro, this is showing how either growth is accelerating or inflation is potentially rebounding. We're more so on this growth accelerating front, though. Fiscal policy is aggressive stimulus and deficits, and mostly deficits are fueling the growth, right? So the growth numbers right now aren't necessarily due to higher consumption from the retail or higher productivity. It's mainly due to government spending. And then this is what's called fiscal dominance. So when the Fed is cutting rates, not because of what the data is saying, but because the government has a debt problem, then that's really saying, okay, the Fed is no longer trying to act in the best interest of the public. They're acting for the interests of the government, right? And this is something where you hear it on TV a lot. Trump always talks about. He says, they should cut the rate to 1. Um, uh, they say, hey, we have a huge debt problem right now, so the interest payment on our debt is becoming one of the largest expenses. We need to drop rates, blah blah blah. But what happens is when you have the Fed start acting to what the government wants instead of looking at growth and inflation with the real economy, you can run into some really big issues there if that continues for a long time. And so, yeah, they're cutting due to politics, which is not their mandate. But this is where the dollar falls. It's falling mostly because of devaluation fears. And yeah, these are the things that typically do well. And these are the things that typically don't do well. Now, what's interesting is that if we end up going into a bear steepening, which is where the 2-year actually reverses up, right, because of what we're seeing, then you could start to see more things like Bitcoin and tech come back, which is kind of what we're thinking about right now. If the other way happens, where the 2-year yield ends up continuing higher and the 10-year yield follows it, then that could go more into a bear flattening, which is actually the signal that we got last week. If you look at the 1-week performance, now I think that's just a little bit of a correction in the steepener, only because things don't go up in a straight line. But that's what could potentially be an outcome. But as of right now, we're more so leaning towards this bear steepener. So that's why we are buying the things that we are buying. But but yeah, that's pretty much all I have for the stream today. Before we log off here and go on over to the Q&A offline for our Macro Optics members, if you'd like to learn more about a membership, you can go to our website, macro-optics.com. For those who are on Instagram, TikTok, or on YouTube, you could just go to the link either in our profile or in the description below, and you can read more about our 2 services. And to gain access to the Sunday Macro Wrap-Up, you can just do the membership. If you want more, though, you can take a look at our partnership circle. And yeah, that's pretty much all I have for the stream. We'll go ahead and log off now. I appreciate everyone for joining on our live stream here on our socials. We're going to continue to go live Monday through Thursday at 3:30 or at 3:45 p.m. So you can join us there daily. Have a good rest of your evening, and I will catch you tomorrow. For those who are on the Zoom call, stay put. Let me log out of the stream, and let's all wave goodbye to YouTube, TikTok, and Instagram here.